Are we live yet?
Yeah. Hello, everyone, and welcome. Today, we're going to talk about how to look at company financial statements and how to use that data to make financial decisions.
Yeah, today will be the first video of the series. We're going to be going over Microsoft's 3 financial statements, and we're going to create a model based off of them. Okay, let me share my screen. Oh. Alan, can you give me permission to share my screen? Okay. So first off, from Google, you can just look up the SEC company search page. You could just look up SEC Edgar on Google. And you click on it, and here you type in the name, ticker symbol of the company. So we're going to do Microsoft today. And then I like to see the classic version of this. And here's the financial filings. And let's go down to the 10K.
Wait a minute.
10K is the annual report. So we're going to click on it. And this 10K report is going to show us a lot of very interesting things about the company. Like right here, we could see how many shares outstanding they have. It's 7 billion. So let's go down to financial statements and supplementary data. It's item 8.
Oh, and
here-
FYI, guys, these financial statements on the SEC website could tell you a lot about the company, right? More than any like chart or anything could tell you. Because in the end, if you're looking for a good investment, you want to know what you're buying. And if you're not looking, if you don't know the company like the back of your hand, why are you investing in it? It's a gamble then.
Exactly. The financial statements, they show basically the company tells us about its products, its risks, everything, the competition. It's all in here in the financial statements. It's very important whenever they come out to read through the companies that you're interested in. Okay, so we're going to do the 3 financial statements, and I'm just going to show you guys how to do it in Excel. And later on, I'll link the Excel thing so you guys can easily do them very quickly. So, whoops. Okay. So let's start off with putting in all this stuff right here. This is the income statement. Okay, let's do. Okay. So their total revenue. Okay, let's do 2020. Oh, whoops. Okay. Their total revenue for 2020 was. This is also, make sure you guys look over here. It's in millions. Okay. So this, okay, let's do it. 143.15. Okay. I'm going to put all the stuff here on the side first. So first comes the revenue, then comes the cost of revenue under that. We're going to call that COGS, cost of goods sold. And then we'll get the total cost of the revenue, which is gross profit. And then underneath, okay, so yeah, revenue minus cost of goods sold equals gross profit. So here, the total cost of revenue is 46,078. And the gross profit is the revenue minus cost of goods sold. Okay. Right here, gross margin, you can see it's the same numbers. Okay, then we have the operating expenses. So first we have R&D. And then we have sales and marketing. And we have general and administrative. Okay, we could also do real quickly just a header over here. Hold on, operating expenses. Let me real quick put some borders on here so it matches the statement. Get rid of that. Let me know if you guys have any questions along the way as I'm doing this. Okay, so 19,269. 598. And Spec, you could talk a little bit about these numbers as well as I'm doing this.
Sure, yeah.
Yep.
Sorry, I
So
didn't want to.
total operating expenses. Okay. So the total operating expenses, we can move this. Oh, whoops. Over here. Delete this line. Okay, we're going to do equals sum. Okay, that's the total operating expenses. And operating income. It's going to be the gross profit minus operating expenses. So let's see if it's matching. And it is matching here, 52,959. And this is in millions, guys, remember. So that'll be, yeah, that would be 52 billion in operating income. Okay.
And the reason why we're looking through financial statements is because you want to invest in companies that has a lot of potential to see future growth. Because the idea is like stock prices, the market, when investing in a market, the market looks at companies in the future. It doesn't look at the present. It looks at what is promised in the future, higher revenue growth, more profit. If it's a declining company, it's not good for the stock. So this is very, very important to understand this principle and use this concept to make these statements and so on and so forth.
Exactly. So here it says other income, and beneath that it's income before income tax. So I would believe that this other income would be interest income. So that's 77. And okay, pre-tax income is what I would call income before income taxes. So that would be operating income minus interest income. And let's see, 52,882. Oh no, it's plus. Okay. There we go. Okay. Just make sure everything matches, Okay. There we go. Okay. Just make sure. And then we have, okay, provision for income taxes, that's taxes. And they are 8,755. 8 billion in taxes, okay. So their net income comes out to be, let's see. $44, no, let's just sum it. $44,281. Okay. And then we can, the way, let's do calculating their EPS. I'll show you guys how to calculate it. It says a number here, but I'll just show you guys. So we have shares, and let's go to the top of the financial statement here. So here it says how many shares there are. There's 7.567 billion shares. Okay, 0.652935. We're going to reformat that into number here. There we go. No decimal places. Yep. Now let's go back to the financial statement and okay, earnings per share. And that equals net income over shares. Oh, yes. And it's the same number as they have. But actually,
Okay.
I like.
Alright.
Yeah.
Okay.
What was that? Sorry. I'm actually going to use a different number of shares. I'm going to use the diluted. They use it for the calculation. This number of shares. So I actually didn't even need to go to the top page. Let's just redo that. 7683. Okay. 7683. Then the EPS comes out as the same as their diluted EPS here. 5.76. It's the same number. Let's reformat that number. Decimal places too. Yes. Okay. Okay. Next, I'm gonna go over some of the ratios. We could do gross margin based off of this. Okay. Gross margin is gross profit over revenue. And this is their gross margin. Let's reformat that into a percentage. 68% gross margin. That's pretty good. That's usually what I see Microsoft having. So that means after their costs, their gross profit over the revenue, that's the gross margin. Okay. Then we have operating margin. We can calculate that. That would be operating income over revenue. And that is 37%. Okay. Then tax rate. So their tax rate is how much they pay in taxes over their pre-tax income. 17%. Okay. Okay, now we've completed putting in the income statement into Excel. We got some ratios from that, and we can use this for further modeling in Excel. Okay, now let's move on to the balance sheet. Okay, so let's put a new section for balance sheet. Hold on. Okay, so let's start off with their cash. Okay, their cash is cash and cash equivalents plus short-term investments. And let me see if they have any other cash on here. Equity investments, yes, I would count that as cash. In general, balance sheets work at, they go from most liquid to least liquid. So liquidity, you guys already know, obviously. It's how fast you could turn an asset into cash. So here, let's start off with 13,576 plus short-term investments is also liquid enough to be called cash. 122,951.
So guys,
yeah,
it's very important to look at the balance sheet for a company because you want to see a company that has more cash than debt.
exactly. It's very important. So that's their total cash. And then accounts receivable. Accounts receivable means it's the money that's owed to them from customers or whatever, and it can be paid back in 60 to 90 days. So it's not liquid at all. They can sometimes not even pay back at all. How companies work with customers. You never know. Sometimes I have to get a collections agency to get the money back. Okay. Let me just label everything. Inventories. Oh, whoops. There is inventories, other current assets, OCA, we'll call it that. Then we have PPE, property, plant, and equipment, operating lease rights of use. Okay. I wonder if I could put that into something else. We'll just leave it as its own category. Operating assets, I guess. Okay. Goodwill. Tangible assets. Other long-term assets. Okay, let's put it all in. Okay. 1895. 11482. Okay. 44151. 8753. 43351. 70338. And 13138. Okay. Then we'll have total assets from this. So we'll just sum it up. And let's see if it's, yep, it's the same number as here, 301311. Okay, and then let's reformat this real quick. Number. Okay. And then after that, we have liabilities and stockholders' equity. I call it shareholders' equity. Okay. So let's start off with accounts payable.
Excuse me, can you mute yourself? Whoever's in the background.
Debt.
Thanks.
Compensation. Let's see, taxes. Deferred revenue. Then we have, let's see, taxes under revenue. Okay, let's call that other, hold on, long-term debt. Okay, I need to put debt here somewhere. Deferred taxes, we don't have that yet. Let's see, taxes, accounts payable, debt, compensation, taxes, deferred revenue, other current liabilities. Okay. Long-term taxes, unearned revenue, that's deferred revenue, operating lease liabilities. We can just short that as actually, let's just short it. Other long-term liabilities, Okay. So accounts payable is 125380. Whoops. Debt is current portion of long-term debt goes into debt, 3749. Okay, let's see what else they have as debt. Okay, long-term debt, yes, that's debt. 578. Yeah, okay, so that's their debt. Okay, compensation. 7874. Taxes are okay, 2130 plus, hold on. Let's see, 29432. Okay. Deferred revenue. Okay, I'm just making sure I'm getting all of it. Here we go. Okay, 3600 plus long-term unearned revenue is deferred revenue. Okay. Oh wait, I already have a debt section. Deferred taxes. Let's see. Okay, here, deferred income taxes. Other current liabilities. Yeah, here we go. 10027. Operating lease liabilities 7671. Other long-term liabilities 10632. Okay. And let's see if this adds up to the total liabilities. $183,007. Yep, it adds up. Okay, perfect. Let me reformat it. Number. Okay. Then we have shareholder equity. Okay, let's see what it is. It's 118,304. And then shareholder equity. Yeah. Hold on. Plus liabilities. Let's see what that equals. Let's just delete this actually. Okay. $301,311. So you see in a balance sheet, sorry about all these notifications. On a balance sheet, the total assets are supposed to equal shareholder equity plus liabilities because it's a balance sheet. Both sides are supposed to be balanced. And yeah, so some very important key things in a balance sheet. You get the cash and the debt, just like Spec was saying earlier. You have the market cap of the company. That's what its market value is. But when a company has a lot more cash than debt, like Microsoft does, that means that when you're buying the company, you get a lot more cash than debt with it. So it's basically undervalued if the balance sheet says this. Okay. Let's move on to the to the cash flow statement. So the cash flow statement, we have our model. So this is our model so far. And our model net income shows, so it shows that the net income for this year, was year of 2020, was 44 billion and 281 million, because it's in millions, remember. Okay. And then the reported net income is the net income that's is over here, and it's the same as up there. Yeah, that makes sense. 281. See, it's the same reported net income as it is on the income statement. Yeah, same number. Sometimes it's different. Okay. So then we can move on to depreciation and amortization. We can add that back from as a cash expense. So the cash flow statement shows where the cash is used in the company, where the cash is used from its revenues. This is where it's used. Okay. So here, depreciation and amortization is 12,796. Oh, let me just label everything though. SBC, stock-based compensation, Let's go with investments here. Okay. Changes, deferred taxes. Let's see. Deferred taxes, changes in operating assets and liabilities. Yeah, we're not going to label that. We're just going to go with, okay, let me just see if I got everything so far though. Stock base, yeah. Okay, accounts receivable. Then we got inventories. So this is where the money is being spent. Other current assets, other long-term assets, accounts payable, deferred revenue, unearned revenue. We're going to call that deferred revenue. Okay, let's see. We have taxes, other current liabilities, other long-term liabilities. Okay, let's put it all in. 5289 minus 219 on investments. Okay. Deferred income taxes, it's 11. This is in millions, 11 million, I guess. Accounts receivable is minus 2577, 168, minus 2330, minus 1037, 3018. Okay. $348. Let's reformat that real quick. Wait 1 sec. Let me do it like that. Okay, good. Okay. Then we got net cash from, we're going to call that cash flow from operations. And it's going to be equal sum and the number is the same as here. So I think on the cash flow statement, the most important part of the whole cash flow statement is if the cash flow from operations, how does that compare to the net income? Where is the cash? How's the cash being used? Or the cash coming from where? So when the net cash from operations is higher than the net income, that's a very, very healthy sign in a company. Okay. So yeah, that's that. We could just quickly, yeah, let's just do this real quick. Okay. Repayments of short-term debt. Yeah, we don't really need to put that. Cash premium on debt exchange. Repayments of debt. Common stock. Other. Okay. The cash premium is minus 34.17. Repayment of debt minus 5518. Common stock. Let's do 1343 minus 22968 minus 15137. Wait, hold on. Other was negative 334 million. Let's see. Okay. And net cash from financing, cash flow from financing is the net income. Let's just do plus this plus this. Oh, wait, hold on. Wait, 1 sec. I think it wants to do equal sum. Okay, yeah. That's the net cash used in financing. And here we see it's negative cash flow from financing. And that what that means is the company is either servicing debt or retiring debt or making dividend payments, stock repurchases. And these are all good things and healthy things for a company to be using the cash for. So that's good. Okay, let's move down to cash flow. Net cash used in investing. Okay. So we have additions to property, plant, and equipment. There's this section has a lot of things that we can use to calculate the free cash flow, but let's just do. Okay, additions to property, that's capex. Capex or capital expenditures. Yeah. So that is negative. Okay. Getting all kinds of notifications. And then we have acquisitions. Okay. So this is the, okay, so to calculate free cash flow, which is a very important part of discounting cash flows. So for free cash flow, it's net income minus the capex. Let's see. So the free cash flow would be, in this case, 59,722 million. So that would be the free cash flow for 2020 of Microsoft. And here we see the net cash used in investing is negative, and that means the company is investing in its future growth. So it's good. And generally, if everything's been good so far and net cash used in investing is negative, that means it's investing in growth, and it's a very good, healthy thing in a company. So yeah, and then here we see the cash. The cash flow statement basically reconciliates the balance sheet and the income statement. So here we see the cash is at the bottom of this is 13,576 billion, and on the balance sheet we see cash is 13,576 billion. So same number. So it should be the same number at the bottom here. So let's see if we can. This is good stuff to know. I'm going to add some more lines here so we could finish this. How many lines do we need to add? Okay, let's just do, this will be investments. This is acquisitions. This is property, plant, equipment. And this is other. So we'll do 1, 2, 3, 4, 5. Okay. 1, 2, 3, 4. Okay. Additions. Okay. Acquisitions. Investments. Other cash flow from investing. Okay. Negative 15,441. Whoops. Negative 2,521. And then we add all these things up together. 77190 plus 66449 plus 17721. So this is the cash they made from investments here. They lost 1241, and the sum of that, it's the same sum as here. Yeah. Okay. And the cash should be the same. Total cash. Let's see. Wait, hold up. I think I did that wrong. Oh yeah, that's correct. Yeah, that's correct. Wait. Only thing is it's minus, hold on. It's minus the effect of foreign exchange rate, Forex. Okay. Let's add a line here for that. Okay, and minus 201. This would be plus this. And we get the same number here. So cash, this is the net change in cash right here. Let's do net change in cash, total change in cash. Okay. Let's add another line. Okay, cash, end of period. Let's see where they got this from. 359, 356. So you see, the end period of 2019 last year will be used for the, where are we here? This is the balance sheet. Okay. One sec. So the end period of the ending of cash in 2019 on the cash flow statement will be the beginning period of the cash flow here. So let's add another line. Real quick. Okay. It was 11,356. And then you add those together. And you get the cash. It's the same. So now we have completed our 3 financial statements for Microsoft. And yeah, we can use this for further modeling to determine discounted cash flows, discount rates, everything good. So this is just the first introduction class on what everything means and the 3 financial statements, how to model them.
Do you want to explain a little bit about the discount rates and discounted cash flow and stuff to everybody so they can understand?
Yeah, definitely. Okay, so we would need some, so to find the free cash flows, we would need to forecast the future revenue growth and how these numbers would change here on the income statement. And then we would need to forecast, there's different ways to forecast how everything's going to change. You can take the historical financials, let's say 10 years backwards, and you could take the average of these kind of ratios and stuff and use to see the year-over-year revenue growth and other stuff like R&D growth average over the past 10 years. You could use that percentage to see how they would grow 10 years into the future. Maybe that's the number you could use. And and then you would calculate the net income into the future, which would be the free cash flow. And you would reconciliate it with the cash and the debt here on the balance sheet and the free cash flow. And then, so you'd forecast the free cash flows, let's say 10 years into the future. I have another example of this in another file.
So to put it very simply, it's like, would you say it's using statistics in order to make little financial models to sort of predict future growth?
Yeah, that's a good way to say it. Yeah, definitely 100%.
Yeah, I'm just trying to simplify it here for everybody.
Mm-hmm. To simplify the discounted cash flow, so let's say, and I have another video up, but where I kind of already completed a model 10 years into the future. But to explain to everybody here, we would predict this 10 years into the future, and then we would use a discount rate to discount the value to the present. So we would have the intrinsic present value of the stock. And we would use that tool, which is one of the most important tools in all of finance. It's basically the $1 million question of who can, predict the stock price, and then who can do it most accurately with these tools. And another tool investors use is comparables analysis. So you would take the enterprise value of the company and apply a multiple to it, like enterprise value over EBITDA. And you would compare it with other companies who are similar companies in the industries. And that's another way to see overvalued or undervalued with the enterprise value. And enterprise value, just again, one more time, is the market cap of the company minus the cash plus the debt. So if a company has more cash than debt, it's a very good thing for the company in general. Like I saw today, Apple had a ton of there was news that Apple has an extraordinary amount of cash compared to debt, which is kind of crazy. Like, when is it going to start maturing? I don't know. What do you think, Mike? Spec.
I think with Apple being such a big, it's not just like, I wouldn't even consider it like a phone. Yeah, like a phone company at this point. It's bigger than just a phone company. There's like this sort of like aura of it's like seen as like sort of like a luxury company too, because people look at Apple as something that they could continually buy as a clout, right? All these different iPhone releases every year, and people just gobble it up and buy it. It's not. I think. I think the future. I think for the foreseeable future, Apple should continue growing. Obviously, yeah, like you said, there's like a time where a company will eventually sort of stall in the growth and then sort of level off.
Yeah, the maturity stage. Yep.
Oh yeah, maturity stage. But
and at that point, it starts to decline in year-over-year revenues and net income, and then at that point, when it's mature, you want to short it for sure when it doesn't grow anymore. Especially if it's overvalued, like if the stock price is much higher than its growth, like if its growth is declining and its stock price is more than its present value, then it might be a good short, statistically. So yeah, this was our first just a basic setup of taking this from this website, SEC website. You search it up, you type in whatever company you want, the stock ticker, or just the name. You find a 10Q or a 10K, and you go to the documents. And everything you need about the company is all over here. The shares outstanding, everything about it. They'll tell you the most about their business than anywhere you could find online, anybody talking about it. Because they have to, according to the regulations of the SEC. And you'll find the historical financials, and you can make models. So we just basically did a first 3 financial statements into Excel. That's what we've done here, and we got some interesting things from it, like the capex, free cash flow. We've gotten the some of the margins and rates, and then later on we can do this for like 10 years into the future and 10 years into the past, and see its revenue year over year, and the average of that, and predict what kind of rate it will grow at. All these numbers here, so we could discount it back to the present.
I just want to say one thing also. I know this may seem very, very tedious. Oh, we got a question too. Like I said, I know this might be very tedious to a lot of you, but you got to understand this business is a very tough business. If you want to be a serious investor and be profitable in the long run, you need to do whatever it takes in order to have an edge. If you're just going on Twitter or whatever, or social media or YouTube, and you see all these supposedly long-term stocks that these gurus are promoting, but you don't understand anything about it, how do you know if if it's a good bet or not? I mean, these guys could be wrong. You can't be a couch investor. Okay, you can't just sort of half-ass this part of it, because I mean, it's a business. It's not going to be all fun. It's work. You got to think of this as work. You need to look at these statements and use it to advantage. It's free. Like, I don't see why not. Like, why wouldn't you look at these statements and just be so well like versed on like the company you want to invest in? Like, it just surprises me that nobody looks at this stuff. Everyone just.
This guy's asking real quick, the free cash flow. I did explain it a little bit, but it's the most important thing that a company produce, like the most important number you can look at in a company, this free cash flow, because this number right here, like that's what the company's share price is worth, essentially. It's future value discounted back to the present here. But go on, Spec.
Oh no, I was just saying that I just don't understand why a lot of people just don't look at these things. They just kind of like play a guessing game, They're like, oh, I think this is a good company because whatever article on the internet said this is a great long-term stock to invest in. Top 10 long-term stocks to invest in.
Yeah, that's, you never want to look at, if you look at that, that's what you're in your mind. It should be thinking, maybe I should short this if they're saying something like that.
It's all noise.
Yeah.
Like,
and also these financial statements, the only reason it took a little bit of time is because I was trying to like explain every single point and do it slowly, so nobody's confused. But after a while, this right here takes like a couple minutes to do. So it's not like tedious. It's not that hard.
Mm-hmm.
I'm sorry, one sec. Somebody just came into my house.
Oh, someone said, Vlad, can you share this file?
Yeah, I can share the file too. And I'll be working on this one as well.
Yeah.
For further classes.
Carlos said something. Vlad? Oh.
Sorry, I had to close my door real quick.
Vlad,
Somebody came home.
Carlos.
Free cash flow is wrong. You want to subtract, but it's actually adding it. Okay. You take the, wait, hold on. I think you want it to subtract. No, it's subtracting it.
Carlos, can you explain why you think it's wrong? But yeah, like I said before, you know, you get all these, you get all this noise in online. You know, you got all these different articles promoting different stocks, but really, you gotta think to yourself: is there like an agenda at play? You know, are they serving an interest of somebody else? You know, there's always conflicts of interest. Why should you listen to some random article on the internet? I don't think they really care about if the average retail investor makes a good financial decision. And I hear a lot of things like, oh, like this company is good because I think this industry is the future. I'm like, okay, yeah, you, let's just say AI, for example, is the future. Yeah, it could be the future, but you got to look at the company itself too individually. What if it's a company that is hemorrhaging cash? You know, the burn rate, it's it's so much where, you know, just like if in a few months or a few years they run out of cash. It's not. It's, you got to think about it logically. Vlad Carlos said something. Says net income is 44,281 minus 15,441 equals 28,840. I might be wrong. I think he's getting confused with. I think Carlos is confused with the formula. I think. I think you're. I'm pretty sure you're right, Vlad. Vlad? Vlad? Are you on mute? Hello? No, I can't hear you, Vlad. Huh. I don't know if you were saying something for like the last few minutes. Yeah, I can hear you now, Vlad.
Can you hear me?
Yeah,
Hello?
yeah. Sorry, were you saying something?
Yeah, I was saying a bunch of things. Oh my god.
Oh my God.
Okay.
Uh,
Anyways, um, okay. I was just asking if Alan's here, and yeah, but I was gonna say, this is our first lecture on the, let's say, Microsoft model that we're doing.
Yeah.
We just went over the three statements, and further in following lectures we're going to go over um, the for calculating future and looking at the historical financials.
Yeah, there's another question that says, can you rank the ratios in order of the most important to analyze a company? Do the ratios differ depending on the sector?
Wait, you guys, did you not hear me talk about that?
I did not hear. I don't know
Oh
if
no.
anyone else heard.
Oh, okay. So I was just saying, like, one thing to look at in the cash flow statement, the cash flow from operations, for example, is the most important thing to look at on the cash flow statement. So the cash flow from operations, if it's great, if this is a greater number than the net income, that's a very good, healthy sign, because that's a very important thing to look at, the cash flow compared to the net income. That's an important ratio, and if it's greater than the net income, that's a healthy sign in a company. Probably the most important thing on the cash flow statement.
Yeah.
And then, okay, another question, like you were, between different sectors, um, depending on the sector, the ratios, the formulas don't differ depending on the sectors, but the numbers are obviously going to be different. And then financial company versus retail. Financial companies' financial statements are going to look different than a regular company's, because financial companies like banks, they make their money off of interest payments and fees, whereas a company like Microsoft makes money on products and services such as computers and other devices, and their operating system and other services.
Cool.
Mhm.
Did you answer Carlos's question or no? I literally
Let's
didn't.
see.
We like missed out on everything you said last few
Oh,
minutes.
really?
Yeah, you're like just I couldn't hear anything. You're just quiet.
Oh,
Like wondering.
crap. Okay, well, um, I mean, the free cash flow, I think this is I don't know, because okay, the free cash flow here on the cash flow statement. So this is the capex, right? It's negative 15,441,000,000, and that's what I have here. Is negative. That's the capex here, and free cash flow is net income minus the capex, and it'll be net income minus a negative number, so it turns into a plus.
Minus.
Okay, yeah, let me type it in. I'll just here type it in the chat. Free cash flow equals net income minus capital expenditures. Oh, I typoed that, but it's okay.
Yeah,
Expenditures.
expenditures. Nice.
Wait, Mike, I mean spec.
Yeah. What's up?
We were gonna, are we still gonna meet up today or no?
Yeah. Text me, DM me.
Okay, got you.
Is there anything else you want to add, Vlad, before we end the session? I mean, this is quite a big introduction for everybody? I think.
Yeah, I don't know if you guys heard me saying this, but I was saying, Spec was saying how it's tedious to do this stuff, and but if you do this enough, doing something like this takes like a couple minutes after, and then it doesn't take too long. Plus, you're gonna have this Excel file, so you could just enter in the numbers and all the formulas are here.
Mhm.
And we're going to keep working on this one as well. And following lectures, we're going to go over the historical financials and see the averages to try to figure out the future values.
Yeah. So we're gonna build upon it. Yeah. Yeah. Like going on again. Sorry. I can't stress enough because statistically speaking, most people lose money in the stock market in the long run. Let's just be real, right? Everyone buys different stocks and thinks that it's a good long-term investment, but in reality, most of these guys who are just blindly buying without any sort of logic or any sort of data to support their idea end up going bust. It's a very tough business. I mean, I know some of you have only been involved in the market since like the last year, and that's like, I don't think they understand, like, when a market gets choppy, when a market when we're in a bear market, it's not as easy as just buying the dip. It's really not. Anyone can make money in a bull market. Everyone is a genius in a bull market, and you buy the dip and it all goes up, right? You can keep buying at the highs and it keeps going higher until the trend changes. That's when the real skill comes in. That's why we want you guys to be really well prepared for the future. There's no such thing as easy money in this game. It's a harsh reality, but that's just how it is. Carlos says, sounds good. Thank you guys. Really fundamental analysis.
Okay.
Yeah, no
Thanks,
problem.
everybody. Glad you guys enjoyed it.
Yep. Thanks, guys, for joining us today on our introduction to financial statements.
Thank you. That was very informative.
Yep.
Great
Alan,
to have you guys here.
Did you cut the stream yet? Alan? Okay. All right. See you guys. Have a nice day.